Good morning. We will pay attention to depreciation on cost price today. When you write of depreciation on cost, it means that you will write of the same amount every year because you will calculate it on the cost price of the asset every year. The depreciation on cost price can also be called straight line because it means it's a straight line every year, it's the same amount, or you can say fixed installment method. So they don't have to use the word cost price. They can say rate of depreciation according to the straight line method or rate of depreciation according to the fixed installment method. That means it's a fixed amount every year. You are provided with the following information. Equipment had a balance of 140,000 and the accumulated depreciation 52,500. Now pay attention to the dates. This is on the 1st of July 2014. That means that you haven't written off depreciation for the current year because we are doing the books from 1 July 2014 to 30 June 2015. To determine if this equipment is the closing balance or the opening balance, you will have to read the additional information. Additional equipment costing 5,600 was purchased on credit on the 1st of April 2015, and this has not been recorded. So it means it's not included in the 140,000. Therefore, the 140,000 will be your opening balance. So you will indicate that on the 1st of July you start with 140,000 and on the 1st of April you buy additional 5,600. Depreciation is written off at 15% on cost. We will work out depreciation on the old equipment from the beginning of the year until the end of the year. On the 140,000 times 15% will give me 21,000. Then on the new equipment we purchase on the 1st of April, and we will calculate depreciation up to the end of the financial year. Remember that depreciation is not calculated on the birthday of the asset when you've used the asset for 12 months. It is calculated at the end of the financial year. So on the 5,600, we will calculate 15,600. We used it for April, May, June, only 3 months, and therefore we will calculate the total as 21,210. Equipment will be debited with 5,600 on the 1st of April to record the purchase of the equipment, and the creditors control and Pullman traders in the creditors ledger will be credited with 15,600. At the end of the financial year, we will write off depreciation, and although it's on two different assets, you will only use the total amount to indicate what is the depreciation on equipment at the end of the year. Depreciation is an expense. Expenses increase on the debit side, so we will debit depreciation. Accumulated depreciation is a negative asset that will increase on the credit side and will keep on accumulating until it reaches the cost price of the asset. The equipment account will be opened with a balance of 140 on the debit side. Equipment is my positive asset, and assets increase on the debit side. Accumulated depreciation is my negative asset, so it means it must decrease the asset, and therefore the balance will always be on the credit side. Equipment and the accumulated depreciation is actually one account. This is the debit side when we buy assets, and to reduce the value of assets, we will credit on the accumulated depreciation account on the credit side. Normally, you will depreciate assets on the credit side here, but because the GAAP requirement is that you have to show what is the cost price of the asset and the total accumulated depreciation, it will be very difficult after a couple of years if all these entries appear in the same account. Therefore, we open a separate account for accumulated depreciation for financial statement purposes, but the principle is that equipment is the positive asset where I increase my assets, and accumulated depreciation is my negative asset where I will decrease my asset on the credit side. We will debit the depreciation account because depreciation is an expense and expenses increase on the debit side. At the end of the financial year, all expenses are closed and transferred to the profit and loss account. So we will close this depreciation account, transferring it to profit and loss, and the amount that will be indicated in the income statement as an expense will be 21,210. When we complete the note for fixed assets to determine what is the amount that must be recorded in the balance sheet, we will show that the equipment had an opening balance of 140. We bought additional equipment for 5,600, so 140,000 plus the 5,600 will give me a closing balance of 145,600. My accumulated depreciation at the beginning of the year was 52,500. We've written off depreciation for 21,210. So the balance in my accumulated depreciation account at the end of the year will be the 52,500 plus the additional depreciation, and that will give me 73,710. At the beginning of the year, I have to show what is the value of my fixed assets. So I determine the carrying amount at the beginning of the year, taking the 140,000 minus the accumulated depreciation, and that indicates to us what this asset is worth at the beginning of the year. At the end of the year, I have to show again what is the carrying amount or the value of my asset, what is it worth at the end of the year. So I take the 145,600 minus the 73,710, and that will give me my closing balance. If I take the opening balance of 87,500 minus the total movements during the year, 15,610, I must get the same answer. Otherwise, you made a mistake somewhere. And this carrying amount at the end of the year of all my fixed assets will be shown on the balance sheet as the value of fixed assets at the end of the year. What did we learn? Determine whether you have to write off depreciation on cost price or diminishing balance before you start doing any calculations. On old equipment that was already purchased in the previous year, you have to write off depreciation for the full 12 months. If you bought new equipment during the current year, you must determine for how many months that you use this new equipment in the current year, and then the depreciation will be calculated for the number of months that the equipment was used in the current year. Depreciation is debited because it increases expenses on the debit side, and the depreciation will be closed off to the profit and loss account and will be disclosed in the income statement as an expense. Accumulated depreciation is a negative asset and will therefore have a credit balance. Accumulated depreciation will increase every year on the credit side until you reach the cost price of the asset, because then you've written off the total value of the asset. Even if you use this asset after this 5-year period, you can't write off any more depreciation because you've written off the total amount.